Okay, so good evening, guys. I would like to take you through the VAT Amendments Bill. Sorry to keep you waiting for this second video. Yesterday, part 1, I shared a video on my channel for the income tax amendment bills proposed to be assented by the to be discussed and assented by the president. So let's look into the VAT Amendment Bill. So this area is very pertinent as well to us understanding the VAT new developments. Yes. So first, subscribe. Second, watch this video and share it and like. Okay, so my name is Elijah, and I'll be taking you through the VAT Amendments Bill. First is the auctioning of goods as a supply of goods. So there is a proposal to amend the act to include an auctioneer as the supplier of goods. So what this means is that when there is an auctioning of goods, you, the auctioneer, if you're one, will be the one considered to be the supplier of the goods. That is one. So for example, the bank appoints an auctioneer normally when they are recovering a loan from a borrower. So that auctioneer acts as a middleman connecting the bank to the borrower. So once they recover the money, they give it to the bank. Yes, and they are paid auctioning service fees. So those auctioning service fees initially were considered financial services, so they are exempt for VAT purposes. As you know, all financial services are exempt. So now the proposed bill states that the auctioneer will be considered as the supplier of the goods. If the auctioneer is selling property, they are the supplier of that property, so they are required to collect VAT from the sale of that property and file returns for the sale of that property, and also file returns for VAT returns for their auctioning services. So these are two different returns. So the challenge which is likely to arise, that this is likely to cause administrative challenges for the auctioneers, since now they are required to file VAT returns from both the auctioning services and the supply of the goods. Yes. Secondly, there is the proposed amendment to digital service providers to include supply of goods. So they define a digital service as a supply of goods from a place outside Uganda, yes, through a digital network to a recipient in Uganda. Or if you're a supplier of digital services, even here in Uganda locally, you may not necessarily be having business running here in Uganda, for example, Google, Facebook, and so forth, but they are required to be compliant with the VAT regulation starting the new financial year if this bill is passed into law. So the same comes with a proposal to amend the definition of place of supply. Place of supply for VAT purposes used to mean any supply made within the boundaries of Uganda. So within the boundaries of Uganda, it would mean that it is a vatable supply. Any supply is beyond a threshold of 150 million during the year by a taxable person. So currently the bill proposes to amend the definition of place of supply, not only to consider supply within the boundaries of Uganda, but also to add a supplier who is based outside Uganda, who does not have operations here in Uganda, but provides digital services to a recipient in Uganda. So you have to look out for that as well, because they are really on the case of digital service providers, and they really want to collect tax from them. And then thirdly is there is a proposal to provide for filing of returns for digital service providers in and paying in US dollars, because the initially the only form of currency for filing returns is only UGX. So now if the main purpose here is that they want, since these digital service providers provide they deal in predominantly US dollars, so they are considering to amend the VAT Act to also consider them to file returns in US dollars and pay for them in US dollars too, to make it easier for them to comply. And then there is a proposal to amend Schedule 1 of the VAT Act. You know, Schedule 1 has public international organizations. So these are organizations, special VAT reliefs. So you need to check out for the special VAT reliefs for those organizations, mainly international, UN, and so forth. So they're adding another company called ZTERE, or PT. It's also called PTA Reinsurance Company, to Schedule 1 of the public international organizations. Can look at the Schedule 1 of the VAT Act, and then you look at these organizations that are entitled to this treatment. So there's also a proposal to amend Schedule 2 of the VAT Act to include to change some areas. For example, diapers now are being considered to be adult diapers only. The children diapers the bill proposes to remove them, to repeal them. So to repeal them from the act means they will no longer be treated as exempt supply. So if you supply children diapers, or you are being supplied children diapers, make sure that the supplier charges VAT. That is if the bill is passed into law. Again, I repeat, this is still a bill. If it is discussed and passed, probably in the next 1 week we will discover if it is passed into law. So most likely many proposals always go through, but few of them are always twisted or removed. So yes, so children diapers are now being considered. I don't know why, but it's normally exempt supplies are those which are essential. Yes. So if they remove them, it means they are no longer essential according to the legislators or the lawyers, and now they consider adult diapers as only essential if this comes to pass. So there is also a proposal to repeal the supply the supply of inputs required for iron ore smelting into billets, because initially they were exempt from VAT. Inputs mainly raw materials, machinery, such equipment required for processing iron ore smelting into billets. So the law the proposal now, the proposed bill is to only consider supply of billets for value addition as exempt from VAT. So the supply of inputs to process iron ore into billets is not being considered, is being repealed. Yes. And then there is repealing of the bill proposes to repeal also the supply of inputs required for processing hides and skin into leather products. So if hides and skin are processed into leather products, they will no longer, those inputs, raw materials supplied for processing hide and skin, machinery, such equipment required. Initially it was exempt from VAT, but now there is, if that section is repealed, then it means that those inputs will no longer be exempt from VAT. So the leather products are normally, as long as the leather products are sold here in Uganda, they will no longer be exempt for VAT. Yes. So unless maybe they didn't clarify, maybe if the leather products are exported, then it means maybe someone is entitled to a VAT exemption. So the law proposes to amend that all inputs supplied for processing of hide and skin into leather products be repealed from VAT exemption. And then there is also a proposal to amend persons required to file a return. Yes. So a person who imports a service, say I import a service like an architectural design for my house. Yes, that person is now, the proposed bill is that they require them to file a return, the VAT return, and collect the VAT on the imported service they file the VAT during the month in which the service was imported, whether the person is registered for VAT or they are not registered for VAT. So also URA would like to collect money from people who are not registered for VAT in order to widen the tax base. So remember that Section 6 of the VAT Act concentrates on the people required to file returns. One is that someone should be having a threshold of should be making an annual turnover of UGX 150 million and above. So if they pass that test, then they are required to register for VAT. So then now, secondly, if someone imports a service, they may not be required to register for VAT, but they will be required to file a VAT return during the month in which the service is imported, including the 150 million turnover. So it means that if you have sold during that month, you also file a return for other sales, including the imported service. You know, VAT is on both sales and purchases. Sales is output VAT, purchases give us input VAT. So the two cancel each other out to see how much payable of VAT the entity has. So yes, there is also a restriction of filing what? The restriction of claiming input VAT. So previously, there was basically a taxable person who supplies who pays for entertainment services. So let's say your employer pays for you gymming services, membership to a club like Rotary Club International, or they provide special services to employees for leisure activities, mainly sporting activities, leisure activities for employees. Initially, they were claim all the input VAT. Input VAT means all those payments you make and you're charged VAT. Normally, you're supposed to offset with your VAT payable. what you have filed as output VAT from your sales is offset by these expenses, administrative and input or purchases. Yes. So all that input VAT from entertainment services is now the proposed bill is to remove it. So it means taxpayers will no longer claim that portion of input VAT from entertainment services. So this is something to watch out for when your company pays for team building, maybe at Garuga, and then they would like to claim that VAT charged on them. They will not be able to claim if this bill is passed into law. So the bill proposes that taxable person who pays for entertainment services will no longer be entitled to claim input tax credit. So that's a restriction of input tax claiming. And then also another restriction is that a person who supplies a non-taxable person in Uganda, so digital service providers like Google and Facebook and WhatsApp, providing services here in Uganda to non-taxable persons. Most of the young people using these platforms are not even taxpayers. They only pay taxes when they buy goods from the shops. That's excise duty and the VAT, but they don't file their personal returns as income, let's say income tax and other kinds of returns. So those are called non-taxable persons. So if a supplier from outside Uganda supplies a recipient in Uganda who is a non-taxable person, there's also a restriction of them claiming input VAT. And also they will not be able to claim input VAT unless it is for deriving the taxable supplies. So let's say Facebook provides services, digital services here in Uganda, so they will normally be required to register for VAT and pay when their threshold or annual revenue exceeds 150 million. So if they register for VAT, they will also incur some expenses here in Uganda. Yeah. So like let's say hosting, yes, and all those other services all those other costs they may incur. So they will not be entitled to claim that portion of input VAT, those purchases or expenses they incurred, if they make supplies to non-taxable persons. So the law is very strict that if you make a supply to a non-taxable person here in Uganda and you're an outsider not from Uganda, normally those are digital service providers. Most of them are digital service providers. That's what they are calling them. They will be restricted from claiming input VAT. So in essence, they are making them to pay taxes but not to claim for the expenses or claim for the VAT on the expenses incurred. Yes, so it is a bit tight for them. Yeah, there is also a proposed amendment to a commissioner seeking consent from the taxpayers to allocate input tax credit. Remember, the current law says that when your input credit exceeds 5 million UGX, let's say you file a return during a month of June. At the end of June, you file a VAT return, and your output VAT from sales you've sold and your output VAT you've charged people, that's why they call it output, is 10 million. And then you have also purchased some supplies for generating that revenue, for generating those sales. If you're hardware, for example, you purchase pipes, cement and all that. So if your input VAT from the purchases you make, if it exceeds this output VAT, let's say output VAT from your sales is 10 million and input VAT from your purchases is 20 million. So it means that you are entitled to claim 10 million from URA. Two things happen. The commissioner now according to the proposed amendment, is that they can decide for you how to claim the 10 million. Either they allocate it to your present tax liabilities. You know, most taxpayers always have some liability with URA. It's mostly the case, yeah. It's very few people clear their taxes to 100%, and even the ledgers don't sometimes reflect. I will talk about the URA ledgers in the near future videos. Yes. So we'll try to understand all these tax matters together, because they are very key to us managing our businesses and turning them profitable, and also tax planning, so that we don't fall into the trap of defaulting in our tax obligations. Yes. So commissioner previously was required to seek consent from the taxpayer on how to allocate or apply their input tax credit. So two options are available: either to allocate your tax credit to any other tax liabilities. Let's say you have tax liability in pay as you earn, or withholding tax, or income tax, and you have this one from VAT, which you are supposed to get from URA, you're supposed to claim from URA. So the commissioner can say, no, you will not receive the refund. We will allocate it to what? To pay as you earn. As long as you agree that is your liability for pay as you earn, they will allocate it to, let's say, pay as you earn, or you will be required to what? To claim the refund. To claim the refund from the URA. So the commissioner initially had to seek consent from the taxpayer on how to allocate that input tax credit, but now the amendment says that there will be no seeking consent, but the commissioner can apply it to any tax liabilities of the taxpayer, or issue the refund, or require the taxpayer to request for a refund. Yes. Okay, so there is also a proposal to transfer the interest capping provision to the Tax Procedures Code Act. Yes. So interest capping means that when you have been penalized by URA and then you fail to pay that penalty attracts interest, or you have a tax liability which you have failed to file a return, that tax which you have failed to pay, or you have not paid. Yes. That tax liability attracts interest, so that interest is limited to only the amount of the tax liability. Get me right, I repeat. Normally, if your tax liability is 3 million in January this year, and then you don't pay it, it starts attracting 2% interest per month for compounded for every period you fail to pay, or 200,000, whichever is higher. 200,000 per month, or 2% of the outstanding, compounded per month, whichever is higher. So if the interest is 2% per month and it exceeds in a future period, let's say it has lasted, your tax liability of not paid maybe in 2 years, then interest exceeds your tax liability of say 3 million, and interest reaches 6 million. So the URA waives off the excess interest. That's what they call interest capping. Interest is capped. Interest is limited only to the tax liability of the taxpayer. So that interest capping is now being transferred to the Tax Procedures Code Act, and Tax Procedures Code Act handles enforcement. It's about recovery of how the penalties a taxpayer faces. So we will see how they amend it. The narration they will give it for recovering that money. I think those are the key areas you need to know about the VAT Amendments Bill. Thank you. Remember to subscribe. Come again in the next video.